If you have federal student loans in default, 2026 could be a very dangerous year for your paycheck. With collections fully resuming, millions of borrowers now face wage garnishment, seized tax refunds, and serious financial consequences. But here's the good news. Default is not permanent, and there are real legal ways to stop garnishment and get back on track. Let's break it down. Why this matters in 2026. After years of pandemic relief and payment pauses, the U.S. Department of Education has restarted full collection efforts. That means garnishment, refund, seizures, and enforcement actions are all back on the table. For borrowers who missed payments for a long time, the risk is very real. And for many, this is happening at the worst time, when living costs are already high. What is student loan default? A federal student loan enters default when you miss payments for about 270 days. Once that happens, the government can garnish up to 15% of your disposable income, take your tax refund, and add collection fees, and they can do this without a court order. For someone living paycheck to paycheck, that can be devastating. First option, request a hearing or review. If you are facing or already experiencing garnishment, your first move should be to request a hearing or review. According to federal student aid, you can challenge garnishment if it causes financial hardship or if there is an error in your loan records. Once you file this request, garnishment can be temporarily paused while the review is pending. This buys you time, and time is critical. Loan rehabilitation, the most powerful tool. One of the strongest ways out of default is loan rehabilitation. Here's how it works. You agree to make 9 affordable on-time payments within 10 consecutive months. The payment is usually based on your income, so it can be very low. Once rehabilitation is complete, the loan is removed from default. The default status is cleared from your credit report. Wage garnishment must stop. This is one of the best long-term solutions. Loan consolidation, the fast option. Another option is loan consolidation. This combines your defaulted loans into a new direct consolidation loan. The big advantage? It works faster than rehabilitation. However, you usually must make 3 voluntary payments, or agree to enroll in an income-driven repayment plan. Once consolidated, your loan returns to good standing and collections stop. Income-driven repayment, your safety net. Income-driven repayment plans are critical in 2026. These plans cap payments based on your income, can be as low as $0 per month and prevent default entirely. If you stay enrolled, your wages are protected, even during unemployment or low-income periods. This is one of the most important protections borrowers have. Why timing matters. One of the biggest mistakes borrowers make is waiting too long. Once garnishment starts, options become more limited. Federal student aid is clear. Borrowers who act early have more flexibility and better choices. The sooner you contact your loan servicer, the better. Special cases, school closures, and disputes. If you believe your loan should not be in default because of school closure, borrower defense claims, or administrative errors, you should request a review immediately. In some cases, collections can be paused while forgiveness or discharge is evaluated. Do not assume the system is correct. Verify. Real talk. What this means for you. Default does not mean failure. It does not mean you are stuck forever. With rehabilitation, consolidation, or income-driven repayment, you can protect your income, stop garnishment, repair your credit over time, and regain control. But you must act. Wage garnishment in 2026 is real, but it is also avoidable. The system gives you paths out if you use them. Default is not the end. It is a situation, and situations can be changed. If this video helped you understand your options, share it with someone who might be struggling. And remember, Awareness plus action. House protection. Thanks for watching.